The 725 billion riddle. I want to give you a number. $725 billion. That's how much Amazon, Microsoft, Google, and Meta are spending on AI infrastructure in 2026 alone. Not over a decade. Not over 5 years. This calendar year. And here's what Wall Street is obsessing over. Which AI company benefits most? OpenAI? Anthropic? Nvidia? The chip makers? But here's the riddle that almost nobody on financial media is asking. What happens to every single dollar of that $725 billion before it reaches an AI model, before a single query gets answered, before one training run completes? What does it touch first? The answer is not a chip. It's not a data center. It's not even a server. It is a wire. And behind that wire is a power plant. And behind that power plant is a completely different investment thesis that most retail investors have completely missed. Because the biggest winners of the AI revolution may not be the companies building intelligence. They may be the companies building the electricity to power it. Today we're going to map exactly where $725 billion in annual AI infrastructure spending flows through the economy, layer by layer, and identify the companies sitting at the most powerful choke points in that chain. This is not a story about the future. The money is already moving. Let's follow it. AI is not digital. It is deeply, painfully physical. There is a mental model most investors carry about artificial intelligence. It goes something like this. AI is software. It lives in the cloud. It scales infinitely and almost for free. That mental model is wrong, and understanding why it's wrong is the foundation of this entire thesis. Let's start with a single AI interaction. When you type a question into ChatGPT, Claude, Gemini, or any modern AI model, here is what actually happens. Your request travels to a data center. Inside that data center, thousands of NVIDIA GPUs, each drawing between 300 and 700 watts of power, begin processing your query. Those chips generate enormous heat, which must be actively cooled. The cooling systems draw even more power. Transformers step down the voltage from the grid. Uninterruptible power supplies hold the whole system stable. All of this happens in milliseconds, and then the response appears on your screen. That single interaction, which felt effortless, consumed electricity, quite a lot of it. Now multiply that by 1 billion daily interactions. Then multiply it again by the training runs that built the model in the first place. A single training run for a large AI model can now consume 50 gigawatt hours of energy. According to a 2025 report submitted to the US Congress, that's enough electricity to power the entire city of San Francisco for 3 days, from a single training run. And according to RAND Corporation research published in early 2025, the power required to train these models has been doubling annually. A single training cluster could demand up to 1 gigawatt of power from a single location by 2028, 1 gigawatt. That's the equivalent of a full-size nuclear power station devoted to training one AI model. By 2030, based on current compute scaling trends, RAND projects' individual training clusters could require 8 gigawatts each, equivalent to 8 nuclear reactors running simultaneously at a single site. This is not a software story. This is one of the most significant physical infrastructure build-outs in the history of modern civilization. And it is happening right now. The demand shock that is breaking every model here is the part that makes this so urgent. The pace of AI-powered demand growth is outrunning every forecast that has ever been written about it. Let's run through the numbers from the most credible institutions in the world. From the International Energy Agency. In 2025, electricity demand from data centers surged 17% in a single year, more than 5 times the global average electricity demand growth rate of 3%. AI-focused data centers grew even faster than the overall data center sector. The IEA's current projection: global data center electricity consumption will double by 2030. AI-specific data center power will triple. From Goldman Sachs, U.S. data center power demand was 31 gigawatts in 2025. Goldman projects it will reach 41 gigawatts in 2026 and 66 gigawatts in 2027. To be clear about what that means, the United States is on track to more than double its data center power consumption in 2 years. Year-over-year capacity additions are scheduled to hit 36.3 gigawatts in 2027 alone. That compares to 6.4 gigawatts added in all of 2024. From RAND, globally, AI data centers could require 68 gigawatts of total power capacity by 2027, comparable to the entire power capacity of California. From the Brookings Institution, if data centers were a country, they would already rank as the 5th largest energy consumer on the planet, between Japan and Russia. By 2026, their total consumption is projected to approach 1,050 terawatt-hours annually. From Bloom Energy, U.S. data center total energy demand will jump from 80 to 150 gigawatts between 2025 and 2028. In plain English, America is adding the energy equivalent of the entire country of Spain to its data center infrastructure in 3 years. And here's the most important data point of all. Goldman Sachs notes that consensus forecasts for data center power demand have been wrong for 2 consecutive years. In the same direction, every year, actual growth came in dramatically higher than projected. In both 2024 and 2025, actual spending growth exceeded 50% against initial estimates of around 20%. The forecasters have consistently underestimated this, which means today's already dramatic projections may themselves be too conservative. The grid crisis that creates the opportunity. Here is why this matters for investors. The electricity grid was not built for this. American power infrastructure was designed for predictable loads. Homes, factories, commercial buildings. It was optimized over decades for a world of gradual, steady demand growth. AI data centers are something completely different. They are enormous, constant, extremely high-density power consumers that operate 24 hours a day, 7 days a week, at near maximum capacity. And they are appearing faster than the grid can respond. Grid interconnection queues, the waiting lists for new electricity connections, are now measured in years, not months. PJM, the grid operator covering 13 states from Illinois to North Carolina, reported that data centers drove an estimated $9.3 billion in price increases in the 2025-26 capacity market. In Virginia, home to the world's largest data center cluster, Dominion Energy proposed its first base rate increase for residential customers since 1992, adding $8.51 per month to the average household electricity bill beginning in 2026. And here is the most dramatic signal of the supply constraint. Between March and June of 2025 alone, community opposition led to $98 billion in data center projects being blocked or delayed. According to research firm Data Center Watch, $98 billion in 4 months. Because communities and local governments are pushing back against the power demands, the water demands, and the infrastructure strain that mega-scale AI data centers impose. This is not a problem that disappears in 12 months. It gets worse before it gets better. And in markets, constrained supply plus exponential demand creates exactly one thing: pricing power. For the companies sitting at the most critical choke points in the AI power chain, this is not a headwind. It is the most powerful structural tailwind in the market. The $725 billion fuel injection. Before we map the investment opportunity, let's understand exactly who is driving this demand. Because the fuel behind the AI power crisis is not one company, or one technology, or one government. It is a coordinated, simultaneous spending surge by the 5 largest technology companies in history. Here are the numbers from the most recent earnings reports. Amazon, $200 billion in capital expenditure projected for 2026, up from $125 billion in 2025. Alphabet, Google, $175 to $190 billion in 2026, up from $91 billion in 2025. Their cloud contract backlog has reached $460 billion, roughly double what it was just 1 quarter earlier. Meta, $115 to $135 billion in 2026, up from $72 billion in 2025. Microsoft, $110 to $190 billion in 2026 depending on the measure, up from approximately $90 billion in 2025. Oracle, $450 billion also up dramatically. Combined, these 5 companies alone are spending $660 to $725 billion on infrastructure in 2026. That represents a 77% increase from 2025's already record $410 billion. And Goldman Sachs projects that these 4 largest hyperscalers combined will spend $5.3 trillion between fiscal year 2025 and fiscal year 2030. $5.3 trillion. Now here's the critical question every investor should be asking. Where does all of that money go? CreditSights estimates that roughly 75% of hyperscaler capex, approximately $450 billion in 2026 alone, flows directly into AI infrastructure. Chips, servers, networking equipment, and data centers. But before any of that infrastructure can function, there is one upstream requirement that nobody in the media is talking about enough: power. That $450 billion in AI infrastructure requires electricity in quantities that the current grid cannot sustainably supply. And that gap is the investment thesis. The 5-layer AI power value chain. Let me give you the single most useful framework in this entire video. Most investors think about the AI value chain in 1 or 2 layers. Layer 1, the chip makers. NVIDIA, AMD, TSMC. Layer 2, the cloud and AI model companies. Microsoft Azure, Google Cloud, Amazon AWS, OpenAI. But there are 3 more layers that sit below the chips, and those layers are where some of the most powerful, least crowded capital flows are happening right now. Layer 3. The inside the data center infrastructure layer. This is the physical layer that exists between the power grid and the actual chips. It includes power distribution units, cooling systems, thermal management, liquid cooling for high-density GPU racks, uninterruptible power supplies, and transformers. Companies operating here include Vertiv Holdings, Eaton Corporation, and Schneider Electric. Layer 4. The grid infrastructure layer. This is the backbone of electricity transmission and distribution. High-voltage transformers, switchgear, grid modernization equipment, and gas turbines. The physical infrastructure that moves electricity from power plants to data centers. Key players: GE Vernova, Eaton Corporation, Quanta Services. Layer 5. The power generation layer. This is the most fundamental layer of all. The actual production of electricity. The fuel for the entire AI stack. This is where nuclear energy, natural gas generation, and renewable power plants live. Key players: Constellation Energy, Vistra Corp, Dominion Energy. Most retail investors have heard of NVIDIA. Far fewer have heard of the companies at layers 3, 4, and 5. But the institutional money, the smart, slow, long-duration capital, has found them. And the earnings are starting to confirm the thesis. The inside the data center layer, where heat is money. Let's start with the layer closest to the chips. Inside every AI data center, there is a war happening. It's a war between computation and heat. NVIDIA's Blackwell GPUs, the most powerful AI chips currently in production, generate extraordinary amounts of heat under load. At scale, 100,000 GPU clusters produce thermal output that traditional air cooling simply cannot handle. The solution is liquid cooling, specifically liquid-to-chip cooling, where coolant flows directly over the processors. And that transition from air to liquid is creating one of the most powerful earning stories in the infrastructure space. Vertiv Holdings, VRT. Vertiv is the dominant provider of thermal management and power distribution systems inside data centers globally. Their liquid cooling systems are becoming the industry standard as GPU clusters scale beyond anything previously seen. In Q1 2026, Vertiv reported 30% year-over-year revenue growth. They raised full-year guidance for the second consecutive quarter. Their backlog stands at $9.5 billion. Organic revenue growth at the end of 2025 was 28% year-over-year. Evercore ISI recently raised their price target to $210, calling Vertiv the single best picks and shovels play in the AI infrastructure era. The logic is airtight. Every GPU cluster that gets added to the hyperscaler build-out eventually generates a Vertiv order. The correlation between AI hardware demand and Vertiv revenue is nearly mechanical. Eaton Corporation, ETN. Eaton occupies a complementary and equally powerful position. They are the dominant provider of electrical switchgear, transformers, and power distribution equipment. The systems that take electricity from the grid and deliver it safely and efficiently to the server racks inside the data center. Their Q1 2026 numbers were extraordinary. Total revenue, $745 billion, up 17% year-over-year. Data center orders, up 240% year-over-year. Data center revenue, up 50% year-over-year. Total backlog, $22.8 billion. The Eaton CEO put the situation in terms that should make every investor sit up. The backlog also equates to 11 years of what was built in 2025. 11 years. At the current rate of orders, Eaton has pre-sold 11 years of its 2025 production capacity. That is not a trend. That is a structural shift in the global demand for electrical infrastructure. The grid layer. The bottleneck. Everyone pays. Now let's move one layer up the stack, or more precisely, one layer upstream. The power that flows into data centers has to come from somewhere. And between the power plant and the data center is the grid. The grid is the most critical, most underfunded, most overwhelmed piece of infrastructure in the entire AI value chain. Transmission transformers, the large devices that step voltage up and down across the grid, have lead times of 18 to 24 months in normal market conditions. Demand from AI is pushing those lead times to 3 or 4 years in some categories. You cannot shortcut this. A transformer is not manufactured in a weekend. It is a precision-engineered machine the size of a house, wound with copper, assembled by hand, and tested extensively before it ships. The global shortage of large power transformers has created pricing power so strong that analysts at UBS are forecasting an Eaton price range of $414 to $495 for 2026, based almost entirely on transformer supply dynamics. GE Vernova, GEV. GE Vernova is arguably the most important infrastructure company in the world right now. They manufacture gas turbines that generate electricity for utilities serving data centers. They produce transformers and switchgear for grid transmission. And they are building the next generation of 800V DC architecture for direct current data center power delivery. In short, they span the entire space between the power plant and the data center. Their Q1 2026 numbers were historic. Revenue, $9.3 billion, up 16% year-over-year. Orders, $10 billion, up 59% organically. Data center electrification orders in Q1 2026 alone, $2.4 billion. That number, in a single quarter, already exceeded their entire full year 2025 data center electrification order total. The company's 2026 revenue guidance is $41 to $42 billion. Their backlog is $163 billion, and management is targeting $200 billion in backlog by 2028. CEO Scott Strazik framed the opportunity with remarkable candor. We're at like 10% of our directional market. If that statement is accurate, and the order growth suggests it may be, GE Vernova is in the early innings of one of the most significant industrial growth cycles in modern history. GEV has risen approximately 165% over the past year, and based on the backlog visibility, multiple analysts believe the growth runway extends well beyond 2026. The nuclear renaissance, the most important energy story in decades. This is the part of the thesis that most investors are either underestimating or ignoring entirely. Nuclear power is having its most significant moment since the 1970s, and it is being driven almost entirely by AI. Here's why nuclear specifically. Hyperscalers need power that is 1. Always on, no intermittency. 2. Carbon-free. Their ESG commitments and regulatory exposure require it. 3. Scalable. They need gigawatts, not megawatts. 4. Local. Grid interconnection delays make remote generation less attractive. Solar cannot be always on. Wind cannot be always on. Natural gas is not carbon-free. Nuclear checks every box. And so every major hyperscaler on Earth has now launched a nuclear procurement program. Microsoft. signed a 20-year agreement with Constellation Energy to restart the 3 Mile Island nuclear plant in Pennsylvania, a facility that had been shut down since 2019. The restarted plant will power Microsoft's data centers. Meta signed 2 separate 20-year power purchase agreements. One with Constellation Energy for 1.1 gigawatts from the Clinton Clean Energy Center in Illinois. One with Vistra for 2,600 megawatts across 3 nuclear plants in the PJM region. Meta and Oklo signed an agreement for a 1.2 gigawatt nuclear power campus in Ohio. Early site work begins in 2026. First power delivery is targeted for 2030. Google signed a power purchase agreement with Kairos Power for up to 500 megawatts from small modular reactors. Amazon equity investment in X Energy, one of the leading SMR developers, and acquisition of multiple nuclear adjacent sites. The International Energy Agency reports that conditional offtake agreements between data center operators and SMR projects have grown from 25 gigawatts at the end of 2024 to 45 gigawatts today. That's 45 gigawatts of nuclear power that has been pre-contracted before the plants are even built. According to industry analysis, each gigawatt of contracted SMR capacity mobilizes approximately $5 to $8 billion in project finance. At 45 gigawatts, that represents $225 to $360 billion in nuclear investment pipeline from AI demand alone. Now let's talk about the 2 publicly traded companies best positioned to capture this moment. Constellation Energy, CEG. Constellation is the largest nuclear power operator in the United States. Full stop. They operate 21 nuclear reactors across 12 sites, spanning the Midwest and Northeast. In Q3 2025, those reactors achieved a 98.8% operating rate, an extraordinary reliability figure. They have now locked in more than 5,650 megawatts of long-term clean energy agreements with hyperscalers. In Q1 2026, they posted GAAP EPS of 4.49, compared to just 0.38 in the year-ago quarter. Adjusted EPS of 2.74 was up 28% year-over-year. Management affirmed full-year 2026 guidance of $11 to $12 per share adjusted EPS. Looking further out, management targets $11.40 to $11.90 in base earnings per share by 2029, implying roughly 20% compound annual growth in earnings from 2026 to 2029. And that figure deliberately excludes upside from incremental nuclear power purchase agreements. They are also pursuing 1 gigawatt of nuclear uprates across existing plants over the next decade, adding more output from facilities that are already built and operating. At a forward PE of approximately 26x and forward EV/EBITDA around 13x, CEG trades at a meaningful premium to traditional utilities. But Constellation is not a traditional utility. It is the carbon-free baseload power provider for the AI era, and the contracted revenue visibility from multi-decade hyperscaler agreements supports a premium valuation. Vistra Corp, VST. Vistra tells a different story, and in some ways, a more interesting one for certain investors. Vistra acquired Energy Harbor in 2024, adding a significant nuclear fleet to its existing natural gas and renewable generation portfolio. Their Q3 2025 revenue was $4.97 billion, with a 21% operating margin. The stock is up 695% since 2021. In January 2026, Vistra signed a 20-year PPA with Meta for 2,600 megawatts across 3 nuclear plants, one of the largest nuclear power deals in corporate history. Fitch upgraded Vistra to investment grade in March 2026, a significant vote of institutional confidence. At a forward PE of approximately 18x and forward EV/EBITDA around 10x, Vistra trades at a meaningful discount to Constellation, partly because of higher net debt, $19.6 billion versus CEG's $5.9 billion, and a more complex generation mix. But that discount also means the AI electricity thesis is less fully priced into VST than CEG. Earnings are expected to jump 49% in 2026, which, if delivered, compresses the forward multiple dramatically. For investors who want AI electricity exposure at a cheaper entry point and are comfortable with higher financial leverage, Vistra presents a compelling case. The capital flow map, where the smart money actually is. Let me now show you what institutional capital flows actually look like in real time, because there is a gap between what gets covered in financial media and what is actually happening in investment portfolios. Gap 1. The hyperscaler CapEx revision pattern. Goldman Sachs points out something crucial. For 2 consecutive years, 2024 and 2025, Wall Street's initial CapEx forecasts for hyperscalers came in around 20% growth. Actual growth exceeded 50% both times. If that pattern repeats in 2026, the $725 billion consensus number becomes $800 billion or more. Every upward revision to hyperscaler CapEx is a direct upward revision to power demand, and every upward revision to power demand strengthens the pricing power of the companies that supply it. Gap 2. The AIPO ETF. In July 2025, an ETF called the Defiance AI and Power Infrastructure ETF launched under the ticker AIPO. It tracks companies that derive at least 50% of revenue from AI hardware, data centers, power infrastructure, or related sectors. Top holdings include GE Vernova, Vertiv, Quanta Services, Eaton, and Cameco. From January 1st to April 14th, 2026, AIPO posted a net asset value return of approximately 29.99%. Over the same period, the Nasdaq 100 returned approximately 2.35%. That is a 27 percentage point outperformance in 3.5 months. The fund crossed $300 million in assets under management in under 9 months and was named Best New Thematic ETF at the 2026 ETF.com Awards. These are not the performance numbers of a niche speculative theme. They are the performance numbers of a genuine structural rotation that institutional capital is embracing. Gap 3. The debt market signal. Hyperscalers raised $108 billion in new debt during 2025 alone to fund their AI infrastructure buildouts. The total projected debt issuance from hyperscalers over the coming years is estimated at $1.5 trillion. When the largest technology companies in the world go to debt markets at this scale, they are signaling something important. This is not an experiment. This is a generational infrastructure commitment they are willing to lever up to fund. The bond markets understood this signal before the equity markets did. Gap 4. The Goldman $5.3 trillion projection. Goldman Sachs now projects that the 4 largest hyperscalers will spend a combined $5.3 trillion on capital expenditure between fiscal year 2025 and fiscal year 2030. $5.3 trillion over 5 years. That is the single largest directed capital deployment in the history of technology. And every dollar of it requires electricity. The question for investors is simple. Which companies control the electricity? 3 scenarios. Where this goes from here. Let's be honest about the range of outcomes, because while the thesis is powerful, no investment case is without risk. Scenario 1. The bull case, the infrastructure supercycle. Everything accelerates as projected. AI model training continues scaling. Inference demand from billions of daily AI users multiplies power needs at a pace that exceeds the most aggressive current forecasts. The grid connection bottleneck deepens, creating multi-year pricing power for baseload electricity producers. Nuclear plants sign 20-year contracts at premium rates. Constellation and Vistra trade to multiples that reflect their true infrastructure value rather than traditional utility frameworks. GE Vernova reaches its $200 billion backlog target. Vertiv captures the liquid cooling standard across the entire hyperscaler sector. In this scenario, energy and grid infrastructure emerge as the single best-performing sector of the late 2020s. Investors who positioned in 2025 and 2026 look back on this as the analog of buying railroad stocks before the Industrial Revolution, or fiber network companies before the internet. The total investment that needs to flow into AI power infrastructure by 2030 is estimated by some analysts at $1.4 trillion. That capital has to go somewhere. The companies in this analysis are directly in its path. The base case: steady structural growth. AI expansion continues but at a somewhat slower pace than the most aggressive projections. Grid connection timelines improve as utilities respond with expanded investment. Nuclear remains in high demand for long-duration contracts, but competition from natural gas and advanced renewables moderates the pricing premium. In this scenario, the power infrastructure companies grow steadily, but with more modest multiple expansion. CEG, VST, GEV, and VRT remain strong performers, but the explosive outperformance concentrates in the earlier phases of the trade. Investors who bought in 2024 and 2025 do well. Investors who buy in 2026 and 2027 get solid returns, with less of the multiple re-rating tailwind. Scenario 3. The risk case, overbuilding and efficiency. The IEA notes something important in its latest report. Power consumption per AI task is declining at an unprecedented rate as efficiency improves. If efficiency gains dramatically outpace the growth in AI usage, the net power demand increase could be far smaller than current projections. There is also the risk of overbuilding. If hyperscalers construct data center capacity that exceeds near-term AI monetization, the question several Wall Street analysts are quietly asking, the pace of new power contracts could slow abruptly. Community opposition is also a real constraint. $98 billion in projects were blocked or delayed in just 4 months of 2025. If this trend accelerates, it could slow the build-out timeline and reduce the urgency premium currently priced into power infrastructure stocks. In this scenario, the power infrastructure stocks that ran dramatically on the AI thesis could give back a portion of their gains as the narrative moderates. This risk is real. But here's the critical context. Even in the most conservative scenarios, AI power demand still grows substantially from here. The IEA's base case, not the bull case, projects data center electricity to double by 2030. Doubling global data center power consumption is not a bear case for energy infrastructure. Even in the cautious scenario, the structural demand is real and lasting. The nuclear timeline. Why patience is required and rewarded. There is one practical reality every investor needs to understand before committing capital to the nuclear side of this thesis. Nuclear power plants take time. Even the fastest nuclear restarts, like the 3 Mile Island project, operate on timelines measured in years, not months. Oklo's meta-contracted campus in Ohio targets first power delivery in 2030. SMR technology, while advancing rapidly, has not yet delivered commercial-scale power in the United States. The 45-gigawatt SMR pipeline that the IEA reports represents future contracted capacity, not installed capacity. This matters for investors. If you buy into the nuclear thesis today, you are buying into a 3 to 7 year development story. The returns are potentially significant, but the timeline requires patience that many retail investors find difficult. Constellation Energy has an advantage here precisely because it operates existing, licensed, running reactors. The 3 Mile Island restart and the various uprate projects are extensions of existing assets, not greenfield development. That near-term cash flow visibility is a meaningful differentiator versus pure SMR plays that are still years from generating revenue. For investors who want exposure to the longer arc nuclear build-out, companies like Oklo, NuScale, and Cameco, the uranium fuel supplier that is critical to every nuclear plant operating or coming online, offer a different risk and return profile. Cameco in particular is worth understanding. As the world's largest publicly traded uranium producer, every new nuclear power purchase agreement signed anywhere in the world eventually requires uranium, and a significant share of that uranium will come from Cameco. The hidden backbone of the AI revolution. Every transformational technology in history had a hidden backbone. The internet was made possible by fiber optic cables. The automobile was powered by the oil industry. Industrialization was moved by railroads. And artificial intelligence is powered by electricity. Right now, the 5 largest technology companies in history are committing a combined $725 billion in 2026, growing to a projected $5.3 trillion by 2030. to build the infrastructure of the AI era. And behind every dollar of that commitment is a fundamental dependency that the market is only beginning to price correctly: power. The International Energy Agency says data center electricity demand will double by 2030. AI-specific power demand will triple. Goldman Sachs says U.S. data center power capacity will more than double by 2027. GE Vernova's CEO says they are at 10% of their addressable market. Eaton's CEO says their backlog equates to 11 years of prior production. Constellation Energy has locked in over 5,650 megawatts of multi-decade nuclear contracts with the largest technology companies on Earth. And an ETF tracking this exact thesis, the Defiance AIPO Fund, outperformed the NASDAQ 100 by 27 percentage points in the first 3.5 months of 2026. The thesis is not theoretical. The money is already moving. The question is whether you understand where it's going before the rest of the market catches up. Because here is what I believe with high conviction. A decade from now, when we look back at the AI revolution of the 2020s, we will not remember it primarily as a software story. We will remember it as the moment when electricity became the most strategically important commodity in the global economy. And the investors who understood that early, who followed the power instead of chasing the software, may be the ones who built the most durable wealth from this transformation. The AI boom has a hidden backbone. You've just seen it. Subscribe, comment. Which of these 5 layers do you think has the most upside from here? The chip makers, the cooling companies, the grid builders, or the nuclear operators? Drop your pick in the comments. And if you want a dedicated breakdown of any single name in this thesis, CEG, GEV, VST, VRT, or the uranium miners, let me know. I'm building the full series.